You're listening to the Allan Gray podcast. I'm Tim Acker, a portfolio manager at Allan Gray and your host for this episode. 2024 has been dubbed the great election year, and it has been mere days since US citizens took to the polls to re-elect President Donald Trump. With the US being such a major global player, investors are weighing up the potential ripple effects Trump's return may have on the global economy and on global markets. But elections are just one of the many factors we consider as we construct portfolios at Allan Gray and at Orbis, our offshore partner. To discuss some of these ideas, I'm joined by my colleague Ben Preston from the investment team at Orbis. Ben is based in London and he directs capital in the Orbis Global Equity Strategy. We'll be looking beyond the US and delving into the opportunities for value investors in markets where Orbis are finding compelling ideas. We'll also talk about some of the interesting tools the investment team at Orbis are using to enhance their investment process. So welcome back to the Allan Gray podcast, Ben, and welcome back to South Africa.
Thank you for having me.
So I was recently made aware you're on the cusp of celebrating your 25th anniversary year at Orbis, which is a nice milestone, and it's almost half as old as Allan Gray, the firm, which is 51 years old. So well done on that.
Thank you for reminding me.
Yeah, it's a pleasure. Yeah, it's an interesting time when you joined actually Orbis, 25 years ago. And it's maybe in some ways the market was quite similar to today. Or what do you think about that idea?
I interviewed at Orbis in February of 2000, which was very close to the top of the dot-com bubble in March 2000. I had no idea about contrarian investing. I was in that sense a classic Orbis hire that we like to get people fresh that don't have these preconceived ideas. But I am scarred by the interview question that I was asked at that time, which is, if you could buy a share today and hold it for the next 5 years, what would you choose? And my answer was Vodafone, which was the cheerleader for the TMT at that time. I think it was priced at £4. 25 years later, it's priced at £1. So I had a lot to learn.
I guess it's quite a good indicator of being a contrarian if you're joining a value manager at the height of the dot-com boom. Yeah, I thought we'd actually start with a tricky question, so something clients ask us about as well. So Orbis has been around for a few decades and it's had a phenomenal track record since inception. It's done really well for clients, but the last 5 or 10 years have been a bit tougher. So maybe just talk us through sort of how you see the recent environment, so the last 5 years, 10 years, and how Orbis has done in that period.
Well, you're quite right. We've had a good track record since inception, but it doesn't all come along at once. And there are those key moments where the opportunity set becomes very rich for bottom-up, fundamental stock pickers who are willing to be different. And the dot-com bubble was exactly one of those times. As you say, it was a fantastic time to join because I saw that play out in real time. And there are a lot of differences to where we are now, but there are also some similarities. In the lead up, and you talked about the last 5 or 10 years, which have been tricky, and it's quite reminiscent of that lead up to the dot-com bubble, in that markets have been driven very strongly by a small number of very big stocks that have gone from kind of expensive to even more expensive. And we've crunched the numbers on that, and it is quite remarkable how much that has skewed how active managers have done. So if you'd picked stocks at random at the start of last year and held them until the end of the last quarter, on average, 95% of those portfolios would have underperformed the benchmark index because it's been that narrowly driven. And so actually within that spread of outcomes, Orbis has done much better. We've done much better than most managers, but we've still lagged the index, which I think indicates just how skewed the environment has been. It's not always like that. You know, often you'd expect the benchmark to be somewhere in the middle. And sometimes it's actually towards the bottom end, and active managers all look like heroes just for picking stocks at random. But certainly as we're looking today, the last few years have been very skewed in terms of how much markets have been driven by a small number of stocks. What it does, if I can just wax lyrical a little bit more about this, but it makes it seem very obvious to the outside world that the easy thing to do is just follow the index. It makes it look like that's a complete no-brainer decision. You should just go passive because you can beat the active managers, 95% of them, and you can do that at a lower cost. it's worth remembering it doesn't always work out that way. And there are times when benchmark indices become so skewed that it's actually much less risky to go the other way. And that was the big lesson that I learned from the dot-com bubble and the unwind, that we were positioned in completely different shares from the big few. And that gave our clients so much protection in the fallout that followed.
Yeah, that's quite a striking number you mentioned, 95% of portfolio. So just to stand still on that, so what you mean there is if you just picked stocks at random, you would almost always have underperformed. And this was in the last 2 years, I think you said?
Since the start of last year, so not quite 2 years. And we did a Monte Carlo simulation. We ran a 10,000 simulations of if you just picked 50 stocks at random from the world index.
Right.
And yes, 95% of them would have underperformed the benchmark. Now, in 2000, only 2 or 3% would have underperformed the benchmark. So it was completely different skew. And in 2009, it was also the case that almost all active managers beat the benchmark. And if you think about when the benchmark's going to do best, it's when those big stocks go from expensive to even more expensive. And the reverse is when either those big stocks sell off, which is what happened in 2000, or you get a rally from the smaller end, like happened in 2009. So anytime you kind of see something that's really obvious, like all I need to do is this, and I can beat 95% of competitors, you have to be a little bit careful and just make sure you're looking over a long enough period of history with enough data in it to be confident in those outcomes.
Yeah, so some of these ideas are like a little bit counterintuitive. Like people's natural intuition would be, it's kind of 50-50, like if a stock beats the market or doesn't beat the market. And, maybe some people would think it's 50-50 whether my manager does better or worse than the index. But actually, you're saying when you crunch the numbers, it's actually very different. This is quite surprising.
Yes, exactly. You would think it would be 50-50. Most of the time, that's about where it is. When it's up at sort of 95.5, we should just talk through the implications of what that does as well, because it seems so obvious just to go for a passive index tracking approach. Every time a dollar of assets makes that switch from an active manager to tracking the index, you're effectively taking the money away from the active manager who might be positioned in some quite cheap stocks, and you're putting that in to the index, which is forced then to buy the narrow group of expensive stocks. So what you're actually doing is you're making that valuation gap even wider. And it becomes self-reinforcing for some period of time until it gets to such an extreme that it becomes unsustainable. And that's when you get some kind of reversal the other way. It's always impossible to tell when that reversal might happen or what will finally trigger it. And that's why markets can go to significant extremes.
Right. So that's sort of the argument that the flows into passive can contribute or exacerbate dislocations in market that can make like these valuation gaps bigger and then possibly create opportunities, I guess, for active managers. And then at some point there's a reversal and then you sort of want to be there to capture when that happens.
That's right. And the challenge for us is not only to be there to capture it when it comes, but also to make sure that we are doing our best during the lead up to this, as the gaps are widening, as the market is, if you like, against our style, to make sure that we're hanging in there and doing okay. And that's why when you look back at the last few years, I would say, our performance has been not where we want it to be in terms of relative to the index. And we just have to be open about that and say we aim for superior returns over the long term. To be lagging the index, even by just a small amount, is disappointing to us. That said, the context is that we've done much better than most managers. And so it's somewhat of a kind of conundrum. We've done better than most, but still not beaten the benchmark. But it's explained by that strange skewedness.
Yeah, I have some sympathy with the Orbis investment team with your benchmark. And if you told me 2 years ago where the NASDAQ is today, where the NVIDIA share price is today, and knowing kind of Orbis's, more value-oriented philosophy, I would have thought, geez, this is going to be a really, really tough place we'll be in terms of performance. And actually, you've managed to do reasonably well without being in those really popular areas.
If you told me that was going to happen, then I think I would have expected to do worse than we have. If you look at the year-to-date numbers, and we crunched them recently, we've actually detracted over 2% just by not owning 6 out of the Magnificent Seven.
Right.
And we've detracted another almost 1% just by being in the cheaper and less popular underperforming currencies. We've actually made all that back, plus a bit more, with the bread and butter stock picking that we do. And that's what we consider our key strength. We're out there. We have a large analyst team of 40-something people who are just going company by company and looking for shares that are trading way below their fair value. And then when we find those, we can buy them and we can earn returns that way. That's our day job. And in doing that, we've actually managed to put back all the detractors that we've lost from being underweight the Magnificent Seven. And so we've kind of come out somewhere pretty similar to the benchmark, but we've done it very differently. Of course, what we look forward to is a time when we can continue to find those value opportunities through the research that we do and add value that way, and no longer face the headwind from a rampant few stocks. And that's when hopefully that our performance will shine through. You can never tell when that's going to happen. History says our philosophy and our approach works, but it doesn't all go in a straight line.
If I ask you to sort of summarize, we've been talking about the environment and, we've been speaking about the dot-com bubble, which was this extreme period. Then you had a few years which were really good for active managers. 2009 was sort of an extreme point. On that kind of spectrum, we've spoken about some parts of the market being very expensive. Do you think we at an extreme, or are we close to an extreme, or are we closer to the middle? Where are we sort of on that spectrum of how unusual the market is, or overvalued, or sort of on any of those metrics?
So in terms of how skewed the market is, we're very extreme. In terms of the valuation that is being applied to some of the bigger stocks, we're quite extreme, but not super extreme.
Okay.
Compared to the height of the dot-com bubble, the big difference now versus then is that back then, those big popular companies were actually cash burning. They weren't earning very much. The fundamentals were poor. Compared to now, these are genuinely fantastic businesses. The only quibble that we have is on the price, but there's no question they're great businesses. And so what does that mean? It means they're not obviously dangerous in the way that a generation ago, the top stocks were obviously dangerous. But on the other measures like the concentration, the amount of market cap that's in one particular theme, on those types of measures, we're as extreme as we've ever been.
And so going on into that, so you mentioned the Magnificent Seven, and I guess people used to call them FANG, and then the acronym changed a bit. So Facebook, Alphabet, Nvidia, Tesla, all the big technology stocks. So, sometimes clients might ask us, Allan Gray and Orbis, you guys are value managers. So that just means you never buy tech stocks. And actually, if the tech stocks are doing well, you just doomed to underperform. So what would be your response on that?
Absolutely not. And it's a misconception.
Okay.
It's a misconception, but it is something that I think we must make sure that we guard against, because that can be a classic response is when people understand our message of intrinsic value. That sounds very much like value investors. A classic value investor would only go for shares that are on a low price to earnings ratio, low price to asset value ratio. We don't think that way. We think about price versus intrinsic value. And what that means to us is the true value of a company, including its future prospects. So a growing company is worth a lot more to us than a company that's not growing. So we will take all of those companies in the Magnificent Seven or wherever else on their own merits. And so we own Alphabet, which is one of those Magnificent Seven. That can seem like an anomaly. People look at our portfolio and say, well, I thought you didn't like the Magnificent Seven. How come then you own Alphabet? And it can feel like it's a contradiction. It's not a contradiction. We go through each of those seven, and the one where we can really find value and get excited about, we've bought. The other six where we haven't, we haven't.
And would you say it's maybe harder for the team at Orbis to get their head around some of these high quality stocks trading on high valuations? It's sort of maybe an additional hurdle for them to get into the portfolio, or it's maybe structurally it's a little bit harder for those shares to end up in the portfolio?
We're value conscious. And so there's definitely an element that we see the dangers of overpaying for shares. And in fact, if you look back at all the statistical history, the biggest risk in investing is the risk of overpaying at the start. And so we are conscious of that. That said, if you look at the way the world has developed, and it's not just the stock market, it's the real world, in terms of the last 10 or 15 years, how the ability for the companies to grow has changed, where the great companies of the past would need to make earnings on one part of their business before they had enough money to then reinvest and expand, put another factory in another town, another shop in another high street, whatever it was. You had to earn and then invest and then keep going. And it was by definition a slow process. Whereas today, these Metas and Googles and Apples can reach many, many people very quickly, often without having to put any capital down because they are virtual businesses. And we've all got smartphones. If they just change one app, it comes onto the first page of all our smartphones, they can reach billions of people worldwide in an instant. And that has transformed how companies can grow. And if they can grow faster than they could before with less capital, then they deserve higher price to earnings ratios. And so as we've learned, we've had to incorporate that sort of thing into our analysis. So yes, we've had to learn those lessons.
Yeah, it's interesting because I can relate to that quite a lot. So we obviously only have one technology stock in South Africa, which is Naspers, which owns Tencent in China. And the first time in many years when we bought that stock was, I think, around 2015, 2016. And at the time, it was quite hard for us at the Allan Gray investment team to get our heads around that, buying a fast-growing company on a high valuation, even though we thought it was attractive on an intrinsic value basis. But actually, it was quite a hard thing for us to sort of make that leap, even though, as your research is telling you, actually it is the right thing to do and the world is changing and so on. But I guess your process also has to evolve and you have to take cognizance of how the economy changes and companies change and so on.
There's the law of big numbers, isn't there? So, the bigger a company gets, then just statistically, the harder it is to keep growing at those same rates. And so I think when we looked at those companies 5, 10, 15 years ago, we kind of projected some growth and then we projected that growth to slow down. And what's astonishing is that you now look at where a lot of these companies are and they're still putting down double-digit growth quarter after quarter, year after year. That's been what's impressed us so much, but what's taken us by surprise at the same time.
Yeah, definitely. I agree. When we look at some of these big technology stocks today, you priced for a lot of growth from a very high base. So you think like Microsoft, $3 trillion market cap, 100 billion in earnings, so 30 times earnings. And if you're going to keep growing at a high teens rate, that's $15 or $20 billion of earnings you need to find every single year for the next 10, 20 plus years.
And here's the kind of interesting thing about learning the lessons. You've got to make sure you're learning the right lessons and applying them at the right time. Given how consistently these companies have maintained that growth rate, you could learn the lesson, well, they can just keep growing like that forever. But it does become harder all the time. Just because they've done it for the last decade does not guarantee they will do it again in the next decade. And as you say, if you look at some of these big companies now are making $100 billion of profit, right? So to grow that at 20% consistently, it's just an order of magnitude harder now than it was a decade ago. So as they've grown, people have kind of absorbed those expectations that they will continue to grow. And perhaps actually the right lesson is, well, it's going to get harder. And yet the multiples have got higher. In other words, people are now more convinced than they've been before that those growth rates will continue. And that's where it begins to look like a classic investment mistake of what works well in the beginning and goes on for many years, gets extrapolated, and people begin to think that it's going to go on forever. That happened countless times in investment markets, from railroads all the way through to .com and many other industries in between. So we're conscious of that risk.
So a lesson many investors have taken, as you said, from the last 5 or 10 years is these technology stocks have kept growing faster than people expected and kept doing really, really well. And the US market has kept outperforming the rest of the world. So would it be fair to say Orbis's view on both of those is, maybe expectations are now being priced a little bit ahead of themselves and actually you're finding more opportunities outside those areas? Is that still true?
I mean, the US is a big market. And so actually, although On the aggregates, the US market looks expensive today, and often we found better opportunities outside the US, like for like. You find two companies, one of which is in the US, one of which is outside, and all else equal, you tend to find a lower price outside for the same level of quality, for the same level of growth. That said, the US is such a dynamic and large market with so many shares in it that we've still found plenty of good shares within the US. And if you look down our top 10, actually, most of them, almost all of them, are American shares. So again, that can sound like a contradiction. It's not. It's just that the US is a big market, and we found opportunities in both.
Okay. And so many investors, when they think of, companies to invest in and global names, they know that the US ones tend to be the ones that come to mind. But what are some of these other places, if you had to give us one or two examples about sectors or countries or other areas of the market where Orbis are finding more opportunities outside the US and outside the big technology stocks?
Well, we found quite a lot of value in Korea, and to make sure we're being careful about this, South Korea.
Okay, good to know. Great, thanks.
Where actually I think that things are changing in Korea for the better for shareholders. And what I mean by that is certain reforms that are taking place. The government, I think, has become the administration changed a few years ago to a more pro-business, pro-market friendly type of administration. And they've realized that capital markets that are inefficient, where the discount is too wide, actually is not helpful for their local economy and the local population. And so they're taking steps to put some reforms into place. That's quite exciting in terms of the amount of value that could be unlocked. And if you cross-check that against the valuations that we're being asked to pay in Korea, it looks like a very sweet opportunity because you've got very low valuations coupled with the possibility of better times to come. As an example, the Korean banks, if you look at the asset value in those companies, you can buy the shares at a 30, sometimes 50% discount to that asset value. And there's nothing particularly wrong with the assets. The complaint that investors have had is that they've wasted some of that capital by making overseas acquisitions and so forth, and saturating the local economy with too much debt. And the answer to those things is very simple. Just increase the dividend payout ratio, buy back some shares, do the sorts of things that have been prevalent in the West for decades. And regulators are now pushing them in that direction. So you're in a very nice situation where not only are valuations cheap, but the sort of fix to bring them back to reality is quite a simple one. And that's been working for us very well this year. At the start of the year, those shares were even cheaper. I don't think many people believed that the change was going to happen. 12 months later or so, there are more emerging signs that it is taking place. And so, the valuations have crept up, but to levels which are still pretty attractive.
Is this similar to the Japan trade Orbis has had for a while? So Orbis has had quite a large position in Japan over the last year or two, which I think has been trimmed a little bit, right?
And that's what's given us a bit of confidence to go for it, because we've seen it play out in Japan. And you're quite right. It looks to us like a very similar setup. And Japan, 2 years ago, we moved quite heavily into some Japanese shares on exactly this thesis. And it was the banks again, and speaking to people in Japan 2 years ago, and they assumed that because interest rates had been zero for 25 years, that was the new normal and it would never change. And it was baked into the valuation of some of these shares. And so you had a situation where actually the banks had done quite a lot of improvement. No one on the ground wanted to believe it because the signs of change hadn't actually come through yet. And so projection was that the same old would continue indefinitely. And that gave us a nice setup because we could look at the shares and say, you know what, we can buy these, and even if nothing changes, we're getting okay value. But if things do change, they're much more likely to be positive change than negative change. And then that could be really good for the shares. That story had a happy ending for us. It worked out almost word for word with what we were hoping for. The nice thing is that we now get a second bite of that cherry because the same dynamics are unfolding in Korea.
And part of the story in Japan was the improving corporate governance and companies being more shareholder friendly, right? So is there a similar push in Korea? Is that sort of a broad sort of movement that's happening in the economy, in the market?
Exactly. It's a slightly different flavor. So with Japan, it was the Tokyo Stock Exchange that wrote to the companies whose share prices were below their asset value and said, this is not good for the country. It's not good to have our capital markets be so inefficient. Please take steps. And there it was on measures like unwinding cross shareholdings, increasing dividend payout ratios, share buybacks. And some of those things are in common with Korea, but it's a different country. So there are different problems to solve. In Korea, a lot of it is about tax reform. The tax rules have been quite punitive. It's something like inheritance tax, where actually in order to minimize inheritance tax, these families that own these big conglomerates actually want the share prices to be low, because when the value is struck for how much tax they need to pay, a lower price is helpful. It makes you need to pay less tax. And so things like that become good for the local families, but not good for the general economy and not good for shareholders, because it keeps prices too low.
Right. So you're creating this perverse incentive for people to do the wrong thing for shareholders.
Precisely. And so there's a number of tax measures that are not exactly established yet. So we still don't know what shape precisely they will take, but it's dividend taxes, it's capital gains taxes, it's inheritance taxes. There's a lot that can be done that's going to make the environment more conducive for shareholders just by making some relatively simple moves.
So the investments in Korea and Japan, I guess those are maybe areas where global investors haven't been looking too closely. So one can understand how there might be opportunities there. It's sort of outside the mainstream a little bit. The other area where Orbis has been finding some opportunities is biotech. And this is one that's I sometimes struggle to get my head around. Some of these companies do things I don't really understand what they do. It seems very complicated. There are lots of scientific jargon involved. Each one is different. They're all operating in different areas. Is that an area where you think a general investor like Orbis, where you can be successful, or do you actually just need to be a specialist? Like, is it actually possible?
It's like, when you're at school and you all go into the exam hall and then you come out, and sometimes it felt like a kind of a relatively easy exam, easier than you were expecting. The problem is if it's easy for you, it's easy for everybody else as well.
Okay.
And often it's when you come out and it's just, oh my goodness, those questions were so hard. It's hard for everybody, and so the playing field gets leveled. I think that's a little bit of the story with biotech, and it's on those harder exams where people that have really done the research can shine through. We were lucky enough to hire an expert in this space, brilliant young student, PhD in biology. She joined our team. She's Chinese. And we didn't hire her particularly for these skills, but she's been able to really understand the science in a way that as a generalist I've struggled with, and has led us through understanding what these companies do, and helped with her combination of the specialized knowledge and us on the senior investment team who have had some experience in the investment perspective. That can be quite a nice combination. And so, we found a couple of opportunities in biotech that I think are quite interesting, particularly when you contrast a lot of the excitement today around artificial intelligence, which requires investors to make very heroic forecasts about what the future might look like, compared to some shares in biotech where, for whatever reason, investors' sentiment is not excited. And so you can make relatively simple and conservative estimates of the future and still find that there's good value there.
Yeah, I was a bit surprised actually when you showed us some of these numbers, because I would have thought biotech seems like this exciting area, and surely there's quite a lot being priced in the valuations. But actually the sector as a whole is maybe not quite bombed out, but it's seems towards the lower end of where it's been valued in the past, right?
I think it's partly because of what you were talking about with the complexity, because if there's not much excitement going on there, in other words, you go through a period where it can be rapid development of new drugs, and then you go through a period more like today where there's not an awful lot of new breakthroughs. Why spend the time trying to understand all these complexities? Anyway, you can just put your attention into AI, and that's where all the action is. So I think biotech is an easy area to ignore when there's not so much excitement going on. But of course, when there's not so much excitement going on, that's when you tend to find that the prices are much better for a long-term investor because expectations are lower and so share prices get more depressed.
Yeah, and maybe an element of things just taking longer than people hope. It just takes longer to develop a drug. It just takes multiple years. Investors kind of lose interest, and actually if you're doing the work and you see there's opportunity, maybe it could actually be attractively valued.
Well, the hit rate for developing new drugs is low. And we've looked at the industry average. Only 7% of drugs that are developed actually make it all the way through to FDA approval by the US authority, which tends to be a drug authority that the rest of the world tends to follow. So very low success rates. We found a couple of companies which I think are much more promising than that, which have got these nice platforms, which have not only created blockbuster drugs historically, but are also continuing to develop exciting drugs for the future. So one of them is a Danish company called Genmab. They do antibodies. Another one is an American company called Alnylam. They do RNA interference. So both of those are quite complicated areas of medicine, which not many companies can do, and where not much has happened until recently. So it's a huge area for future development without an awful lot of competition. And the remarkable thing is if you take both of those companies and you say, okay, let's just look at the value of the existing drugs that they've got, relatively easy calculation, then your investment today is covered just by that value. If they can use their superior platforms to produce more drugs in the future, all of that extra effectively comes for free. And versus an industry success rate of only 7%, these companies have got more like high teens success rate because they've got these effective platforms. So I know it's a complicated area, but if one strips it down, it's just you're underpaying just for the bit that's already known, and all of the future opportunities come along you get as well. And that's in stark contrast to something like an NVIDIA or a Tesla, where you have to make very aggressive assumptions for the future just to make today's share price work.
Yeah, it's interesting how you can actually compare these companies in completely different industries, where in the one case, as you say, the technology companies, you have these very high expectations. Everything needs to go right for you to get the current share price. Where with the biotech examples you mentioned, it's almost like just the basics, the things they're already selling, that sort of justifies your share price, the cash flow from those products. And then if something does go right on the research of the new products, then that's all upside. So a much better sort of setup.
And we don't know what the future will hold. And so there's a natural risk in these types of shares that things could go against you. They're not huge parts of the portfolio, but they are. If we can build a portfolio based on that kind of share where, the future is not precisely knowable, but we can put the odds on our side. And if we can do that over and over again and build a portfolio where the odds are on our side, then that's the sort of thing that ends up statistically doing better for you than not.
So on that idea of the future not being knowable, I want to make sure we talk about the US election, which has just passed as we're recording this. So Donald Trump has been re-elected. Before the election, we had a lot of questions from clients. What do we think is going to happen? How is your portfolio positioned? But maybe a broader question for me is actually just, does it matter? Does the Orbis team spend a lot of time thinking about this? And does it actually matter for your portfolio and the kind of stocks you hold?
It matters, but it's also the sort of thing that we recognize is not our bread and butter skill set. And so we don't spend our time trying to predict these type of events. What we do is we say, okay, look, what could happen in this scenario and what could happen in that scenario, and make sure that our portfolio is appropriately balanced for the exposures that can come in both of those kind of binary events, without necessarily thinking that we can add value by taking a view. Because whenever you get an election or a big economic release or something of that nature, there's an awful lot of people giving attention to that. And so to imagine that we can do better than people at that sort of game, that's not our skill set. But if you have a team of 40 people who are looking where others fear to tread, going further and going deeper into individual shares, we think we've got a lot more mileage to add value that way. So something like the US election, we looked at the portfolio, we recognized there were some companies in our portfolio that would actually benefit from a Trump win. Things like the health insurers, where Trump tends to be a deregulator, so that would be helpful for them. And there were other companies in there, something like AES, which is an electricity generator of renewable energy, where they would rather have had a Democrat win because Trump was going to potentially take away some of the subsidies that renewable energy producers have relied on. So within the portfolio, you've got some that would rather have had Trump, some that would rather have had Harris, and then a lot of companies in the middle that it was probably not that relevant to either way, something like the Korean banks. So what we did is say, look, we don't know who's going to win. And even if we could figure out who's going to win, we don't necessarily know what they're going to do, because what you say on the campaign trail might be quite different from what you do when you're in office. But we could just check our exposures and make sure we're not too skewed one way or the other. And that's kind of how it's played out. Trump won, and some of our shares benefited from that, and some of them lost. And, there were a lot of big moves quite quickly in the aftermath of the election, and it settled down. That it hasn't made a huge difference for us relative to the index one way or another.
It's interesting the comment you made on sort of building a portfolio for either outcome in the election. It sounds very, very similar to what we were telling South African clients on the South African election. So a similar kind of approach and philosophy, which is probably not surprising given we share a common investment philosophy between Allan Gray and Orbis. So maybe this is a good time to talk a little bit about the investment process. So over your years at Orbis, I'm sure you've gotten to know some of the ins and outs of Allan Gray quite well. And I want to talk about some of the changes that have happened at Orbis, but maybe before we get to that, so we have this common philosophy between the firms, but there are differences in process and how we apply that. And maybe from your point of view, where do you think those differences lie?
The biggest difference of all is that we have an opportunity set of 5,000. Now, there's benefits of having a wider opportunity set, because within 5,000 shares, you're more likely to find a few that are real outliers valuation-wise. So that's our advantage. What I've noticed is the Allan Gray team is often re-looking at shares that are already relatively well known to the Allan Gray team and refining, staying ahead of the competition by going deeper on shares that you kind of already know. And for us, a lot of it is actually we're looking at companies for the first time, because by the time you've gone through the whole 5,000, let's say metaphorically, some of them have changed, and it's like painting the fourth bridge. You get to the end and you have to start again from the other side. So we're often looking at companies for the first time, and I think we've developed processes that have tried to incorporate, the challenge of doing that, the challenge and the opportunity with being able to go into greater depth. So, for example, we've put a lot of emphasis in crunching numbers to see from our analyst team what are the main insights that we can glean. We generate a lot of signals within a 40-person investment team, each of whom is covering multiple shares, making decisions on which ones to add to their paper portfolio, which ones to take out of the paper portfolio. There's 10,000 signals for the portfolio managers like me to absorb in an average year, 10,000.
So that's just internal, just to
clarify. That's just internal.
Okay.
That's before you get to Bloomberg and Reuters and all the noise from the outside world. But in an average year, we might only change the portfolio of 60-ish stocks. We may only add another 8 to 10 significant new stocks. So how do we get those, from those 10,000 signals, which ones are the most important 10 to make a difference to the portfolio? So we put a lot of emphasis process-wise into making sure that we are getting the right signal from all that noise. And then having done that, then we've built tools to make that a reality for a portfolio manager. We put a lot of effort into that, particularly in the last 2 or 3 years since Adam Carr took leadership of the investment team. He's had a big focus on innovation. How can we get better? This is a competitive sport that we play, and if we're not continuously raising our game, we're going to get left behind. So how can we make sure we're always on the front foot, innovating to make sure that with our team we're getting the most important signals coming through for us to respond to as PMs?
Some of those changes would be IT things, so actually technology and systems changes and investments in technology, and some of it's more workflow process, kind of how the team fits together and how you surface all those signals to the managers.
All of the above. It's been a combination of, first of all, go and get our quant team. We've got a very good quant team full of maths PhDs that can crunch numbers better than we can. And so they will be analyzing those signals and saying, you know what, there's a key insight here. So I'll share one of them as an example. When an analyst has a paper portfolio of their 10 favorite shares, it's often the top couple, 2 or 3 shares that have the most value. Their very favorite shares are where a lot of the value is created. So isn't that nice to know as a portfolio manager? I can put a lot more of my focus into understanding their top few shares. And that's just one example of some of the statistical findings that we've made. Then we can build tools that optimize around those things. So all the information we're not looking at any new information than we've had for years, but we're putting it together. We're packaging it up for our portfolio managers in a way that the most important things shine through.
So just to get an understanding of this, you mentioned these 10,000 signals. So that would be something like your analyst on Alphabet has changed his intrinsic value of the stock after doing some research, and you want to surface that signal to the portfolio manager, but also there are 10,000 other signals, and you want to filter out the really important ones that matter for what actually happens in the portfolio.
The clearest signal that an analyst can give us is buying a share for their paper portfolio. The clearest input that they use for that is the intrinsic value estimate. And so there was an array of ways in which these communications would happen. I liken it to the difference between going to a library and digging out an encyclopedia versus just having all the information that you need just there on Google. So it's not been something that we've necessarily reinvented any of the process. In fact, the philosophy have always remained identical. But what we're doing is making sure that we're being disciplined about crunching the numbers, seeing what are the most important things to pay attention to, and then making sure that we built a tool so that I can see those straight away when I get into the office every day. What are the new signals that are most important that have been generated, and I can get straight into that.
Yeah, it's interesting. I sometimes think investing is only about filtering signal and noise. There's so much information out there. You want to find the important things. And then even internally with your own research, there's a lot happening, 40 analysts, plus in the team. So just filtering those sort of top ideas.
There's an angle where it's been very individual. So we have a different team, a decision analytics team, which is they crunch numbers on us as individual investors. So that is a separate but equally important effort where as you mentioned at the start, I've been around for a while, nearly 25 years. And so there's a lot of data that's been collected purely on my own personal investment decisions. And so by examining that data, you can see what are the patterns of my behavior? What are the biases? What are the mistakes that I've been making? How can I improve? And so we've gone through a process of me sitting down with that coaching team, if you like, and them flagging to me, these are the 3 important lessons that we've learned from looking at your own patterns of behavior, and they're giving me individual coaching tips on how I can improve. All the top sportsmen have coaches because they are incentivized to improve. And if you look at the way that we run our team and have our analysts, it's very clear that analysts are driven by their own individual performance. So they're very incentivized to get better. And so they are hungry for this data because they are saying, like, I think I can do this. I want to put my maximum effort into it. But if there's any way that you can tell me how I can improve, I'm all ears. So the reception's been very positive.
Okay. Yeah, it's always interesting to learn about what the quant teams and analytic teams at Orbis are doing and thinking about, which of those things we could incorporate at Allan Gray. So I asked you a little bit about some of the differences in the process at the 2 firms, at Allan Gray and Orbis. But if I just think of my time here, the firms have gotten closer, I think. The investment teams are collaborating more and have become more integrated over time. And part of that has been, as the Allan Gray team have also started investing globally in some small parts of some of our portfolios. I mean, what are your thoughts on sort of the benefits or not of the 2 teams working together and where we could learn more from each other or leverage more?
Well, there's one school of thought that says, if you're going to pick contrarian shares. You have to think independently, and that kind of means locking yourself in a box and just surrounding yourself with your own thoughts. And that has its advantage for independent thinking. It's difficult for new ideas to cross those walls that you've locked yourself inside. Surrounding yourself actually by other thoughtful people who can bounce ideas off with you and chew things over, I find very valuable, particularly in today's very complicated world. And so I'm really enjoying that we're working more closely together. I think there's so much wisdom at Allan Gray, and to compare and contrast, the processes and look at, what's working here, what's working there. Can we take the best bits from both? There's magic in that. And it's a big part of why I wanted to come down to Allan Gray. Obviously, a lot of our clients come through Allan Gray, but it's also just great to sit on the 5th floor with you guys and learn from the way you do it and just build those bonds.
Yeah, I've definitely found it useful where there are sectors that are of common interest. So Richemont is a big stock in our index, the luxury company. And speaking to the Orbis analyst on luxury stocks, just hearing her perspective on the different luxury businesses around the world that we also look at, but we can definitely learn a lot there. And similar on the Chinese stocks, we look at Tencent, but it's so useful speaking to the Orbis emerging markets team who look at China all the time, and they're much closer to China than we are. So definitely some learnings there. I mean,
classically, most of the Allan Gray team are South African nationals. And so a lot of the Orbis teams, our analysts come from all over the world. We've got, Chinese, Indian, Korean, European, American, Brits. In terms of understanding local cultures, that can be important. But boy, you at Allan Gray really know some industries way better than we would ever have the chance to do for ourselves. 2 of our analysts came over just a couple of weeks ago to go down some mines in South Africa because they wanted to learn about mining. And where better to come than South Africa, and who better to learn that industry from than Allan Gray analysts?
Yeah, I believe it was quite a shock to their system, but they enjoyed it going down the mine shaft. So I hope it was a useful experience. I'm going to finish off with one last question, which is maybe unfair or maybe not. But so you look at all the countries around the world, including emerging markets. I know South Africa is not a country you typically look to invest in because obviously we have the team here at Allan Gray. But maybe your thoughts as an outsider on South Africa. We've had this election. There's more positive sentiment. The market has done quite well recently. What would be sort of your take as an outsider on the attractiveness of SA?
Well, don't listen to me because I'm an outsider, but I have been coming to South Africa for a while and I love it here. I first came to visit the Allan Gray team in, I think it was 2003, so over 20 years. I've been a regular, frequent visitor, and there was a lot of enthusiasm, I think, in the air when I first started coming here, relatively recent democracy, and so much progress was being made. It was lovely to see. And then I think over the last few years, what I've seen is people being a little bit more despondent on South Africa, and more people starting to grumble about the politics and the inefficiencies and capital not going into the parts of everyday life that you need. And last year when I was here, I was midway through doing a presentation and the lights went off. And I was quite shocked. Nobody else in the room batted an eyelid because that was just normal. Now I come back, right, 12 months later, and the electricity seems to be magically working. Right? And you don't have a single party state anymore because there's a coalition. As an outsider, I have a distrust of single party states. However good the party might be, it's just a corrupting influence if you're never going to lose power. So South Africa still has its challenges, but I will say that compared to this time last year, it's looking more encouraging.
It's amazing the improvement in mood if the lights just stay on. It definitely helps if you're doing a presentation as well and the lights stay on.
For sure.
And that brings us to the end of episode 23. Thanks to Ben for joining us, and thank you for listening. In this episode, we discussed the evolving market environment, opportunities for investors outside the US, and the ways Allan Gray and Orbis are enhancing their investment process. If you'd like to get in touch, please send an email to info@allangray.co.za. You can subscribe to this podcast on your favorite podcasting platform to be notified of new episodes. Lastly, Allan Gray is an authorized financial services provider. To view our terms and conditions, please visit allangray.co.za. Until next time, I'm Tim Akker. This podcast was produced by Volume Podcasts.
There's a song that goes, "Money can't buy me love." And that's true. But then they told us all you need is love, which anybody with a mortgage will tell you most certainly is not true. Love won't pay your parking tickets or your student loan. It's also needy. It requires effort, availability, constant care. But more importantly, love requires time. And while money can't buy you love, it can certainly free up some of your time. Time to spend on the things you love, with the people you love. And if you're looking, maybe even time to find the one you love. That's why, after 50 years of investing, we've learned that time is the greatest gift of all. And the good news is, if you invest early, time gives you money. And then money gives you more time to do the things you love. And don't you love that about investing? Ellen Gray, long-term investing. Ellen Gray is an authorized FSP.